Anticipated 30% decline in investment flows, an in-depth analysis. Executive summary. By the first quarter of 2025, investment flows across key sectors, real estate, technology, manufacturing, and retail, are expected to decline by approximately 30%. This anticipated downturn has significant implications for both emerging markets and developed economies. The decline is largely attributed to persistent inflation, economic uncertainties, geopolitical tensions, and shifts in global policies. Key findings suggest that emerging markets will bear the brunt of decreased foreign investments, and sector-specific impacts will lead to slowed growth in critical areas. Key drivers of the decline. 1. Economic uncertainty. Reports indicate that economic uncertainties stemming from elections, trade policies, and geopolitical events are primary drivers behind the anticipated investment decline. Countries with unstable political climates, particularly emerging markets, will likely see diminished investment confidence. 2. Sector-specific effects. The real estate and manufacturing sectors are expected to experience the most significant challenges due to high borrowing costs and reduced consumer confidence. This situation is likely to stifle new construction projects and manufacturing activities. 3. Inflation and interest rates. Persistent inflation continues to pose a threat, influencing central bank policies that are expected to tighten further. Increasing borrowing costs will further inhibit investment flows, especially in capital-intensive sectors. 4. Emerging market vulnerability. Emerging economies such as Mexico and Nigeria are particularly vulnerable due to political instability, currency depreciation, and high inflation rates. Reports indicate that these markets may contract due to a lack of investment confidence. Timeline of events. 2024. The year began with optimism about economic recovery following pandemic-induced disruptions, yet persistent inflation led to revised forecasts by late 2024. Late 2024, economic growth forecasts were adjusted downward, indicating potential declines in investment. Q1 2025, the expected 30% downturn in investment flows is projected, influenced by geopolitical tensions and policy shifts. Sector-specific impacts. Real estate. Decline in new construction, high borrowing costs, and a lack of consumer confidence are expected to lead to a marked drop in new construction projects. Market adjustments. The real estate market is poised for significant adjustments, with a potential shift in focus towards affordable housing in response to economic conditions. Technology. Investment slowdown. The technology sector may face a slowdown in venture capital investments, particularly in startups that rely heavily on foreign funding. Shift in focus. Companies may pivot their strategies towards efficiency and cost-cutting measures rather than expansion. Manufacturing. Reduced production, high raw material costs, and reduced consumer demand may lead to a decrease in production levels, particularly in emerging markets where manufacturing relies heavily on foreign investment. Supply chain disruptions. Ongoing geopolitical tensions may exacerbate existing supply chain issues, further impacting the manufacturing sector. Retail. Sluggish consumer spending. With high inflation affecting disposable incomes, consumer spending is expected to slow down, adversely impacting retail performance. Adaptation strategies. Retailers may need to adapt by focusing on e-commerce and enhancing customer engagement to drive sales. Regional implications. Emerging markets. Investment confidence. Countries like Mexico and Nigeria face heightened risks of contraction due to political instability and high inflation rates. The anticipated decline in investment flows could exacerbate economic challenges in these regions. GDP growth projections. For instance, Mexico's GDP growth is projected to slow to about 1% in 2025 due to reduced investment confidence. Developed economies. Mixed projections. Developed economies may experience varied impacts. While some may benefit from enhanced domestic investments, others could face challenges due to reduced exports and increased inflationary pressures. Policy responses. governments and developed economies will need to navigate between controlling inflation and stimulating growth through effective fiscal policies. Conclusion: the anticipated 30% decline in investment flows by Q1 2025 is a complex outcome of intertwined economic, political, and sector-specific factors that could redefine growth trajectories across both emerging and developed economies. Proactive policy responses will be essential to mitigate the impending economic impacts and to foster an environment conducive to investment recovery. Understanding the nuanced dynamics of each sector and region will be critical for stakeholders to navigate the shifting economic landscape successfully. Recommendations: 1. Enhanced policy coordination. Governments should focus on stabilizing economic conditions through coordinated fiscal and monetary policies to restore investor confidence. 2. Investment incentives. Offering incentives for domestic investments can help cushion the blow from decreased foreign capital. 3. Focus on resilience. Sectors should adopt resilience strategies to adapt to changing economic conditions, including diversifying supply chains and embracing digital transformation. 4. Stakeholder engagement. Continuous dialogue with stakeholders, including businesses and investors, will be vital to understanding and responding to emerging trends and challenges. By addressing these recommendations, economies can better position themselves to rebound from the anticipated investment decline and lay the groundwork for future growth. The anticipated 30% decline in investment flows across the real estate, technology, manufacturing, and retail sectors by Q1 2025 presents a complex tapestry of counterintuitive insights that challenge conventional economic wisdom. Here are several key counterintuitive elements extracted from the provided information. 1. Resilience amid decline. While there is an expected decline in investment flows, certain economies, particularly the United States, show signs of resilience with forecasts of GDP growth despite the broader global downturn. For example, the U.S. economy is projected to grow by 2.4% in 2025, which is notably stronger than many global counterparts, suggesting that certain developed economies might thrive in a context of global investment pullback. 2. High inflation versus strong consumer spending. Despite persistent high inflation and elevated interest rates, U.S. consumer spending is expected to remain robust. This challenges the typical expectation that high inflation would suppress consumer spending. In fact, the U.S. labor market strength coupled with inflation-adjusted wage growth has led to sustained consumer demand, which is somewhat at odds with the narrative of widespread economic contraction. 3. Emerging markets adaptive strategies. Emerging markets like Mexico and Nigeria, which are expected to suffer from reduced investment flows, also exhibit potential for recovery through local policy adaptations and changes in governance. For instance, Mexico's GDP growth is forecasted to remain positive at 1% in 2025 despite political uncertainties, suggesting that emerging markets may find unique pathways to resilience even amidst global investment declines. For sector-specific divergence, the anticipated decline in investment isn't uniform across sectors. For example, while real estate and manufacturing face significant slowdowns, sectors like technology may experience a more nuanced impact. The shift towards digitalization and remote services could continue to drive investment in tech-related areas, indicating that not all sectors will be equally affected by the decline in overall investment flows. 5. Geopolitical factors redefining investment dynamics. The geopolitical landscape, particularly U.S.-China relations, is expected to reshape investment flows in a way that might benefit certain regions. For instance, if U.S. tariffs on Chinese goods rise, companies might relocate operations to countries like Mexico, which could paradoxically enhance investment flows in those markets that were previously considered risky. 6. Decoupling of economic growth from investment flows. The narrative traditionally posits that investment flows are crucial for economic growth. However, countries like India are expected to see growth alongside a slowdown in investment inflows, driven by domestic demand and government spending initiatives. This suggests a decoupling of growth from foreign investment, indicating that local consumption and policy effectiveness may play a more significant role in growth than previously thought. 7. Investor behavior and market sentiment. The surveys indicating a potential recovery in the real estate sector despite overall declines highlight a complex investor sentiment. The notion that investors might be willing to enter the market despite a general decline in investment flows suggests a strategic shift where quality and location become more critical than quantity of investment. 8. Public policy as a counterweight. The role of government policy becomes increasingly critical in navigating these declines. Countries like Canada anticipate moderate growth supported by stable fiscal policies despite external pressures. This implies that proactive government interventions can mitigate the impacts of global economic slowdowns, challenging the idea that economies are solely at the mercy of global market trends. 9. Long-term investment perspectives. The decline in investment flows might prompt a re-evaluation of investment strategies focusing on long-term sustainability and resilience rather than short-term gains. This shift could lead to more significant investments in sectors like renewable energy and infrastructure, diverging from the traditional focus on immediate returns. 10. Behavioral economics of savings and spending. The increased savings rates observed in various economies, particularly in the Eurozone, demonstrate a behavioral shift where consumers prioritize savings during uncertain times. This contradicts the expectation that economic uncertainty automatically leads to decreased savings and increased spending, indicating a complex interplay between consumer confidence and economic forecasts. These counterintuitive insights underscore the multifaceted nature of the anticipated decline in investment flows and illustrate that while the overall economic outlook may seem bleak, pockets of resilience and unique opportunities may arise in unexpected places. The anticipated 30% decline in investment flows across real estate, technology, manufacturing, and retail sectors by Q1 2025 is a critical issue that may not receive the attention it warrants. Below are some often overlooked aspects of the report along with their significance. 1. Sector-specific vulnerabilities and interdependencies. While many discussions focus on the broad economic factors such as inflation and geopolitical tensions, the intricate relationships between sectors often get overlooked. For example, the decline in real estate investment affects the manufacturing sector due to reduced demand for construction materials and labor. Similarly, lower technological investments could stifle innovation in manufacturing processes. The interconnectedness of these sectors means that a downturn in one can lead to a cascading effect, exacerbating the overall economic downturn. Significance. Understanding these interdependencies can help policymakers and investors develop more comprehensive strategies to mitigate risks. A failure to recognize these relationships may result in reactive measures that do not address the root causes of economic decline. 2. Emerging markets' unique challenges. Stakeholders often focus on developed economies when discussing investment declines, but the report highlights specific vulnerabilities within emerging markets. Countries like Mexico and Nigeria are particularly at risk due to political instability, currency depreciation, and their heavy reliance on foreign investments. While these factors are mentioned, the urgency of their implications tends to be understated. Significance. Emerging markets may experience a more severe contraction due to their vulnerabilities, which could lead to increased poverty and social unrest. Policymakers in these regions should prioritize creating a stable investment climate to attract foreign capital. Ignoring these dynamics may lead to missed opportunities for foreign investors. 3. Long-term policy implications. The report notes that the anticipated investment decline is not a mere blip but a symptom of deeper issues, including persistent inflation and shifts in global policies. However, the long-term implications of these trends, such as changes in trade agreements or shifts in labor markets, are often overlooked. Significance. As economies grapple with inflation and geopolitical tensions, the need for adaptive policies becomes crucial. Failure to anticipate long-term shifts may lock economies into outdated structures, inhibiting recovery and growth. Policymakers must remain agile and responsive to these evolving dynamics. 4. Consumer behavior and confidence. While economic indicators are essential, the report underscores the importance of consumer sentiment, which can significantly influence investment decisions. The anticipated decline in consumer confidence driven by economic uncertainty could deter businesses from expanding or investing in new projects. Significance: understanding the psychological aspects of consumer behavior can inform better strategies for businesses and governments. As consumer confidence wanes, proactive measures that restore trust can stimulate economic activity and investment. 5. Technological investments role. The technology sector is expected to see a significant downturn, yet the implications of this decline for future innovation and competitiveness are not fully explored. A reduction in investment could stifle advancements in critical technologies, impacting productivity across various sectors. Significance: technological innovation is a key driver of economic growth. A decline in investment in technology could hinder productivity improvements and economic competitiveness, making it crucial for stakeholders to prioritize this sector even amidst economic challenges. 6. Geopolitical risks beyond trade wars. While the report mentions geopolitical tensions, it primarily focuses on immediate trade implications. However, the broader geopolitical landscape, including conflicts, shifts in alliances, and global governance, can have far-reaching implications for investment flows. Significance: investors and policymakers must consider the broader geopolitical context when making decisions. Understanding these risks can help in crafting strategies that are resilient to geopolitical shifts, thereby safeguarding investments. 7. Impact on employment and labor markets. The report discusses economic forecasts but tends to understate the potential impact on employment. A 30% decline in investment flows can lead to job losses in affected sectors, further exacerbating economic challenges. Significance: the labor market is a crucial component of economic stability. Addressing employment impacts should be a priority, as job insecurity can lead to reduced consumer spending and increased social unrest. Proactive measures to support affected workers can mitigate these risks. 8. Environmental and sustainability considerations. The intersection of economic decline and sustainability efforts is often overlooked. As investments decline, there may be a corresponding decrease in funding for sustainable practices and technologies which are essential for long-term economic health. Significance: sustainable development must remain a priority even amidst economic challenges. Neglecting this aspect could lead to greater environmental degradation and future economic costs. Policymakers should integrate sustainability into recovery plans to ensure resilience. 9. Financial market reactions. The report primarily focuses on real sector implications but downplays the potential volatility in financial markets. A significant decline in investment flows may lead to increased market uncertainty and volatility, affecting investor sentiment across the board. Significance: understanding the relationship between investment flows and financial markets is crucial for anticipating broader economic impacts. Policymakers and investors should monitor these trends to inform their strategies. Conclusion: the anticipated 30% decline in investment flows across key sectors presents complex challenges that necessitate a multifaceted approach. By recognizing the significance of often overlooked factors such as sector interdependencies, emerging market vulnerabilities, long-term policy implications, consumer behavior, and the broader geopolitical landscape, stakeholders can better position themselves to navigate the impending economic landscape effectively. Proactive strategies that address these dimensions will be essential for fostering resilience and recovery in both emerging and developed economies. Here are the 4 most valuable points for in-depth analysis and discussion regarding the anticipated 30% decline in investment flows across the real estate, technology, manufacturing, and retail sectors by Q1 2025. 1. Economic uncertainty and its implications. The anticipated decline in investment flows is largely driven by economic uncertainty fueled by geopolitical tensions, inflation, and changing global policies. This uncertainty is particularly pronounced in emerging markets, which are often more reliant on foreign investment. The implications of this trend include potential slowdowns in economic growth, increased volatility in financial markets, and decreased consumer confidence. Policymakers in both emerging and developed economies will need to carefully navigate this landscape to mitigate adverse effects, emphasizing the need for robust economic policies that foster stability and growth. 2. Sector-specific challenges. Different sectors will experience varying degrees of impact from the predicted decline in investment. Real estate and manufacturing are likely to face significant challenges due to high borrowing costs and reduced consumer confidence, leading to a slowdown in new construction and manufacturing activities. Conversely, the technology sector may exhibit resilience, albeit with shifts in investment focus towards more sustainable and innovative solutions. Understanding these sector-specific dynamics will be crucial for stakeholders to adapt their strategies and investment decisions accordingly. 3. Vulnerability of emerging markets. Emerging markets such as Mexico and Nigeria are particularly vulnerable to the predicted decline in investment flows. Political instability, currency depreciation, and high inflation rates contribute to a lack of investment confidence in these regions. As foreign investments retract, these economies may experience contractions, further exacerbating existing challenges. Policymakers must prioritize reforms that enhance economic stability, attract foreign investment, and promote sustainable growth to mitigate these vulnerabilities. 4. Global economic interconnections. The anticipated decline in investment flows is not an isolated phenomenon. Rather, it has global implications that will affect both emerging and developed economies. Trade uncertainties and shifts in investment strategies can lead to disruptions in global supply chains and trade flows, affecting economic performance worldwide. This interconnectedness underscores the need for international cooperation and coordination among governments and financial institutions to address shared economic challenges and foster resilient global markets. In-depth discussions on these points can explore the broader implications, potential policy responses, and strategic adaptations required to navigate the anticipated economic landscape leading into 2025. Here are 3 historical cases that reflect significant declines in investment flows, economic downturns, and their global implications, similar to the anticipated 30% decline in investment across various sectors by Q1 2025. 1. The Great Depression, 1929 to 1939. The Great Depression was a severe worldwide economic downturn that started in the United States following the stock market crash of October 1929. The decade-long depression led to a dramatic decline in both consumer spending and investment. In the U.S., GDP fell by nearly 30% and unemployment soared to 25%. This economic collapse had ripple effects across the globe, severely impacting economies in Europe and Latin America. Many countries faced high inflation, currency devaluation, and political instability as a result of the economic turmoil. Investment flows dried up as businesses faced uncertainty, leading to a decline in manufacturing and construction activities. The global implications included shifts in trade patterns as countries sought to protect their economies through tariffs and other protectionist measures, further exacerbating the economic crisis. 2. The Asian financial crisis, 1997 to 1998. The Asian financial crisis began in Thailand with the collapse of the Thai baht, leading to widespread economic instability in Southeast Asia. The crisis quickly spread to neighboring countries including Indonesia, South Korea, and Malaysia. Investment flows into the region plummeted as investor confidence eroded due to fears of currency devaluation and economic mismanagement. In Indonesia, for example, GDP contracted by more than 13% in 1998 and unemployment skyrocketed. The crisis had significant global implications, including a slowdown in global economic growth and a reassessment of investment strategies in emerging markets. Many countries in the region implemented austerity measures and reforms to stabilize their economies, but the effects of the crisis were felt for years with long-lasting impacts on growth trajectories. 3. The global financial crisis 2007 to 2008. The global financial crisis triggered by the collapse of the subprime mortgage market in the United States led to a severe worldwide recession. Financial institutions faced unprecedented losses, resulting in a credit crunch that severely restricted investment flows across multiple sectors, including real estate, technology, and retail. Global GDP contracted and unemployment surged, with millions losing their jobs. The crisis had profound implications for both emerging and developed economies, leading to significant government interventions, bailouts of financial institutions, and sweeping regulatory reforms in the financial sector. The decline in investment during this period not only stymied economic growth but also reshaped global trade dynamics, with many countries adopting protectionist measures in response to the economic downturn. These historical examples illustrate how significant declines in investment flows can lead to economic instability, affecting various sectors and having far-reaching global consequences. They highlight the interconnected nature of global economies and the potential for localized crises to escalate into broader economic challenges. The anticipated decline in investment flows across the real estate, technology, manufacturing, and retail sectors by 30% by Q1 2025 signals a critical juncture for both emerging and developed economies. This downturn, driven primarily by persistent inflation, geopolitical tensions, and economic uncertainties, will have far-reaching implications. 1. Economic uncertainty and investment confidence. Economic uncertainty remains a predominant factor affecting investment decisions. As countries approach pivotal elections and navigate geopolitical tensions, investor confidence is expected to wane. Emerging markets such as Mexico and Nigeria, which heavily depend on foreign investments, are likely to experience significant contractions. In contrast, developed economies may exhibit more resilience, though they too will feel the strain of reduced investment flows. 2. Sector-specific impacts. Real estate. The real estate sector will likely face challenges due to high borrowing costs and reduced consumer confidence. Forecasts indicate a marked decline in new construction projects, particularly in urban areas that were once booming. This could lead to increased vacancy rates and falling property values, impacting both investors and homeowners. Technology. The technology sector may see a slowdown in venture capital funding as investors become more risk-averse in light of economic uncertainties. Startups may struggle to secure necessary funding, hindering innovation and growth. Manufacturing. High interest rates could stifle manufacturing expansion, particularly for capital-intensive industries. A decrease in consumer demand may lead to production cuts and layoffs, further exacerbating economic woes. Retail. The retail sector, already facing challenges from e-commerce, may experience a contraction as consumer spending declines. Retailers could struggle with inventory management, leading to increased markdowns and reduced profit margins. 3. Global inflation and interest rates. The persistent inflation across major economies is a critical concern. Central banks are expected to continue tightening monetary policies, leading to higher borrowing costs. This could further restrict investment flows as companies and individuals become wary of incurring debt. The anticipated rise in interest rates may also deter consumer spending, compounding the challenges faced by the retail sector. 4. Emerging markets vulnerability. Emerging markets are particularly vulnerable to these economic shifts. Countries like Mexico and Nigeria are expected to experience contractions due to political instability and currency depreciation. The lack of investment confidence, coupled with high inflation rates, may result in reduced economic growth or even recession in these regions. 5. Regional differences in policy responses. While the decline in investment flows will be felt globally, the impact will vary by region. Developed economies with more robust financial systems may implement policies to mitigate the downturn. Proactive measures may include fiscal stimulus, regulatory adjustments, and targeted support for affected sectors. Conversely, emerging markets may struggle to respond effectively due to limited fiscal space and higher vulnerability to external shocks. The need for comprehensive policy responses will be crucial in navigating this challenging economic landscape. 6. Future outlook and recovery strategies. Looking ahead, the anticipated decline in investment flows presents both challenges and opportunities. As the global economy adjusts to new realities, sectors that embrace innovation and adaptability may emerge stronger. For instance, sustainable investments. There is a growing emphasis on sustainability, which may drive investments in green technologies and renewable energy sources. Companies that prioritize sustainability could attract investment despite broader economic headwinds. Digital transformation. Sectors that leverage technology for efficiency and productivity may find new avenues for growth. Investment in digital transformation could help businesses navigate economic challenges more effectively. Policy innovation. Governments may need to adopt more innovative policy responses to stimulate growth and restore investment confidence. This could include incentives for businesses' infrastructure investments and measures to enhance economic stability. Conclusion. In summary, the anticipated 30% decline in investment flows by Q1 2025 is a complex outcome of intertwined economic, political, and sector-specific factors. Both emerging and developed economies will need to navigate this challenging landscape with proactive policy responses and strategic investments in innovation and sustainability. The path to recovery will depend on the ability of governments and businesses to adapt to changing conditions and seize emerging opportunities.